I'm Wouter Den Haan. I'm a professor here at the LSE, and my only job this evening is to make a couple announcements and then to introduce our speaker. So I think the first announcement is that if you want to tweet, the hashtag is hashtag LSE Econ. I suspect it's one E. Maybe that's a typo, maybe that's intentional. The other thing is about the timing. So Gabriel is going to talk for roughly 30-40 minutes, and then after that there's going to be Q&A, and we'll probably end around 7:45. And then make sure that your mobile is on silent, otherwise he may frown upon you, and that's never been a good thing. And so now let me introduce our guest. So to do that, I first want to tell you a little bit about international economics. So for years there was this, this big outstanding puzzle, is that capital seemed to flow, right, from the poor countries to the rich countries, and it seemed that countries like the US and Europe is that they were having these very low net debt positions. They had these debt positions relative to the outside world, and the numbers just didn't add up. And so 2 years ago, we were trying to hire some new young people. And in the academic world, it all happens at the same time. Right? So all schools are all trying to hire young people at the same time, and there's sort of rumors and buzz. There's even a website, Econ Job Market Rumors. And so 2 years ago, there was this buzz going around. There was this brilliant young kid from Paris who had sort of solved this big puzzle that all these smart guys had been struggling with. And that was Gabriel. And what he had realized is that he had to be a lot more careful about the data. And in particular, you shouldn't forget all the stuff that Americans and Europeans owned in tax havens. And so, that sort of completely changed our view about, what we actually had to explain. So we thought that, of course we invited him, and we thought we were never going to have a chance. He was going to go to, top school like Harvard or MIT. But guess what? He liked us, and so I think we're very lucky that he came to us, and this evening he's going to give you guys hopefully a nice evening. So please join me in welcoming Gabriel.
Okay, thank you very much. Thanks for having me, and thanks for being here. So I'd like to talk about inequality and taxation in a globalized world, starting from the fact that income and wealth inequality have increased a lot in recent decades. Just to fix ideas, in the UK, the top 1% income share used to be about 6% in the 1970s, and now it's about 14% today. So it rose to about 15-16% prior to the financial crisis, and it dropped a little bit, and it seems to be rising again over the last few years. This is more, broadly a phenomenon that you observe in all Anglo-Saxon countries. So in the US, the top 1% income share is even higher than this. It's more of about 22% of total income that accrues to the top 1% of the income distribution. So that's a general phenomenon. You have the same phenomenon for not income, but wealth. Wealth is the value of all the things that people own, the financial assets, equities, bonds, mutual fund shares, minus their debts and plus their real estate. That's wealth. We have good data for the US that show, and I'll show the graph just in the next slide, that the very top wealth shares are booming, and wealth is getting more and more concentrated in the US. There's evidence that this is also true at the global level. By the way, first of all, I should apologize, because for the UK we don't actually know a lot about the wealth distribution. Okay, so we don't really know what's happening in the UK. We have a clear sense of what's happening in the US. Yesterday there was a report by Oxfam that said, basically if the current trend is sustained, the top 1% wealth share, the worldwide, the top 1% global wealth holders will own just 50%, half of world wealth next year or in the next few years. Okay. Of course, that's very uncertain. We don't even know what's going on in the UK, so how can we exactly know what's going on at the global level? But I think that that's a plausible order of magnitude. The top 1% at the global level owns maybe 45 50% of total global wealth, there's also clear indication that wealth concentration globally is rising fast, especially since the financial crisis. So these facts have triggered calls for more redistributive tax policies. One way to address ever-rising top income and wealth shares is maybe, first of all, to have higher top marginal tax rates on income. So in this country, the Labour Party, for instance, says that it advocates a top marginal tax rate of 50% for income above 150,000 pounds against 45% today. So there are some calls for, moving from 45 to 50 or maybe 60 or maybe 70% top tax rates for very high incomes. Then there's the famous proposal by Thomas Piketty of having a global wealth tax, of having taxation not of the flow of income that people earn, but of the stock of wealth every year, the 1, 2, 3, or maybe 5% wealth tax for fortunes of dozens of millions of dollars. The question I'd like to address tonight is, can we do this? Is that feasible? And under which conditions can we indeed increase top income tax rates and think about wealth taxation in a globalized world? So before I move to this, just the facts. That's the key fact for the US. That's a graph that shows the time evolution of the share of total US wealth that belongs to the top 0.1% of the population in the US. To fix ideas, to be part of the top 0.1% today in the US, what you need is a total net wealth of more than $20 million. So top 0.1%, that's 160,000 families with net wealth above $20 million. And this group of the population used to own about 15, 20%, up to 25% of total US wealth in 1929. So wealth concentration was high in the early 20th century. Then there was a dramatic reduction in wealth concentration during the Great Depression, during World War II, and then a long period of remarkable stability in the top 0.1% wealth share in the 1950s, 60s. In the 1970s, this was a very bad time for very rich people because, in particular, equity markets performed very poorly, so the top 0.1% wealth share fell at its historical low of about 7% in the late 1970s. And since the late 1970s, you've had this gradual and spectacular recovery all the way back, or almost all the way back, to the high levels of wealth concentration observed in the early 20th century. The latest data point for 2012 is a top 0.1% wealth share of 22%. Now, the flip side of this is the decline in middle class wealth. So that's the share of wealth and the composition of the wealth of the bottom 90% of the population in the US. You have this widespread view that one key structural change that has happened over the course of the 20th century is the rise of middle class wealth. That is, 1 century ago, you did not really have a wealthy middle class. And then, yes, it's true, there has been a lot of accumulation of wealth for the middle class, in particular because of the rise of pension wealth and the rise of relatively equally distributed housing wealth. And so indeed, the share of wealth that belongs to the bottom 90% in the US increased from a low of 15% in the early 1930s to a high of 35, 37% in the early 1980s. But what has happened since then, since the early 1980s, is a gradual decline in the share of wealth owned by the bottom 90%. So yes, the middle class owns, and that's one key difference with the past, a lot of pension wealth and some houses, but basically it owns nothing else, and it also has a lot of debts, especially in the US, mortgage debt, student loans, consumer credits, auto loans, credit card debt, and so on. So when you see this, okay, you have these calls for let's try to boost the income, for instance, of the middle class, so as to enable the middle class to save more and to accumulate more wealth. One way to boost the income of the middle class, maybe you have a little bit more progressive taxation, higher tax rates for the wealthy. If you have this, you want to keep the overall tax rate constant, and you can actually decrease the tax rate for the middle class. You can cut property taxes, you can have tax credits, you can have lower tax rates at the bottom of the distribution. Now, globalization raises potential difficulties if that's indeed what you want to do. So what are the potential challenges? One challenge is that there's tax competition between countries. Tax competition between countries, for instance, low tax rates for footballers. Many countries, including the UK, have this for researchers, for multinational companies. Trying to attract a tax base in your own country. By providing some parts of the population with particularly low tax rates. One other challenge is tax avoidance by multinational companies. Tax avoidance by multinational companies, you should think of this as exploiting the loopholes of the corporate tax as it exists today. That's usually, not always, but usually done within the letter of the law, although not the spirit of the law. And although sometimes multinational companies do engage in completely illicit tax evasion like Enron. But most multinational companies at least try to respect the letter of the law, but the letter of the law allows for many ways to actually artificially shift your profits to low or zero tax countries like Bermuda. And that's being widely used by US multinational companies, but not only US multinational companies like Google, Apple, Amazon, multinational companies from all over the world. Then there's the third problem, which is tax evasion by wealthy individuals. How does that work? Traditionally, this meant having undeclared bank accounts in offshore tax havens like Switzerland, like the Cayman Islands, and so on. More broadly, this means trying to disconnect yourself from your wealth. Trying to, you're very wealthy and you're going to claim that, all this wealth that exists in the world does not belong to you, despite the fact that in reality you are the actual beneficial owner of this wealth. So how big are these challenges and how can they be overcome? Let me start with multinational corporations, tax avoidance, and tax competition. What you need to realize is that the corporate tax as it works today is broken. And so this creates ample opportunities for multinational companies to dodge taxes. It also makes it very difficult to solve the problems of the corporate tax if we remain in the current framework. We need to rethink the way that we tax multinational corporations. Why is it so? It's because the way we tax multinational corporations, we invented this in the 1920s. It's based on three principles. It's based, first of all, on the principle of source-based taxation. Imagine you live in the UK, but you own a company in Chile that produces coffee in Chile. Source-based taxation says any profits made in the coffee producing activity will be taxed in Chile. It will not be taxed in the UK where the shareholders live. It will be taxed in UK where the profits are made. That's source-based taxation. Second principle is what I call arm's length pricing. Imagine that this Chilean company is actually part of the multinational group. There's a headquarter in the UK that imports coffee from the Chilean subsidiary and that distributes coffee to the UK market. So some profits actually are made in the UK, some profits are made in Chile. Some profits arise from coffee production, some profits arise from actual distribution to the final customers. How do you determine which fraction of the profits are made in the UK and which fraction is made in Chile? The rule is that you are going to do as if the two subsidiaries are completely independent and they trade coffee, they import and export coffee among themselves as if they were unrelated at the market price for coffee. So at the end of the day, this makes some accounting profits appear in Chile, some accounting profits appear in the UK. That's what's taxable in the UK, and the accounting profits in Chile are taxable in Chile. And the last rule is that we are not going to solve the way to tax multinational companies with a multilateral global agreement like we do for trade, the General Agreement on Tariff and Trade. Instead, we are going to have thousands of bilateral tax treaties between the UK and Chile, the UK and France, the UK and the US, that broadly respect these two principles of source-based taxation and arm's length pricing, but differ in many ways. Now, all of this did not matter a lot until recently, for the very simple reason that there was not a lot of profits made abroad. So that's for the US, that's the share of the profits made abroad in total US corporate profits. So up to the 1970s, less than 10% of all the profits of US firms were made abroad. Then this remained pretty low until 1990s, and then you have this boom in the early 2000s, and that's continuing today. That's globalization on a very large scale. Now 35% of all the profits made by US firms are made not in the US or made abroad. And so now these choices made in the 1920s, where there was very little actually, globalization was much less than today. Now these choices are coming back to haunt the tax authorities. Why? Because each of the three principles that were agreed upon in the 1920s raise big issues. Bilateral agreement instead of a global multinational agreement, this gives many opportunities to multinational firms to strategically choose the location of their subsidiaries to exploit inconsistencies between the tax treaties. That's what Google, Google has its headquarters in the US, a subsidiary in Bermuda, a subsidiary in Ireland, a shell company in the Netherlands. That's the so-called double Irish-Dutch sandwich that's exploiting all the inconsistencies between the tax treaties, US, Ireland, Netherlands, Ireland, Bermuda. And the end result of all this is that a very large fraction of Google's profits appear as being made in Bermuda or booked in Bermuda, where the corporate tax rate is 0%. So that's the problem with bilateral agreements. The problem with arm's length pricing is that there are billions of intragroup transactions every year. The tax authorities cannot check that all of them are correctly priced at the correct market price. And so if it's coffee that's being traded between subsidiaries, it's quite easy to check. But if it's logos, algorithm, intellectual property, intellectual capital in general, what's the relevant market price for these intragroup transactions, that's simply not defined. The reference prices, in many cases, and increasingly so because of the rise of intangible capital, do not exist. So this notion that we can allocate profits across countries by having this arm's length pricing system, that was maybe fine for the 1920s, that's not fine for 2015. And the last problem is source-based taxation. It's fine, but then it gives incentive for firms to move not only accounting profits, but real activity, headquarters, workers, factories, where taxes are low. Okay? Bottom line is that, again, the way we tax multinational corporations is not adapted anymore to today's globalized world. So can we have a sense of what's the cost of all this for governments? That's hard to quantify. There are many technical issues. My approach is I start from national accounts data, on total income, GDP, income earned from abroad, and so on, trade. And I focus on the case of the United States. The question is what's happening to the profits of US-owned companies. So again, think Amazon, Google, and so on. And that's the latest data. So the latest data shows that profit shifting, artificial profit shifting to low tax jurisdictions, to tax havens, is rising fast. Remember, I showed earlier a graph that showed that roughly 1/3 of all the profits of US firms are made abroad. Now, this graph decomposes where these profits are made. Okay, they are made abroad, but in which country? So 55% of all the foreign profits of US firms today are made in 6 low tax countries, Ireland, Netherlands, Luxembourg, Switzerland, Bermuda, and Singapore. And the point is that this is growing every year, okay? And this is growing pretty fast. So 1/3 of all the profits of US firms are made abroad. 55% of these foreign profits are made in low tax countries. The consequence, when you combine these two figures, the consequence of this is that about 20% of all US corporate profits, either made by multinational firms or not, including the profits made by the numerous firms that only have domestic activity, 20% of all these profits are booked in tax havens today. Again, no, that was only 2% in 1984. So that's a tenfold increase. It increased a lot during the Great Recession and financial crisis because foreign profits remained pretty strong, whereas domestic profits collapsed. And since then, it has stabilized at a high level. What's the cost of this? Try to think about a simple computation, which is, on the numerator, you have all the taxes paid by US multinational firms, either to the US governments, that's the green curve, or to the US, that's the red curve, or to the US and to foreign governments, that's the green curve. That's the numerator, and you divide this by all US corporate profits. So if you do this computation, this gives you the effective tax rate, which is paid in reality by US firms. The nominal tax rate in the US has been very stable since the late 1980s. It's 35%, okay? But in practice, yes, in the early 1990s, the effective tax rate was, 30%, not very far from 35%, but since then, the effective tax rate paid by US multinational firms, by US firms, all US firms, has declined a lot, and today is about 20%. And it was about 45, almost 50% in the 1950s. Why does that matter? This matters because the corporate tax is one of the key ways to tax capital. Okay, the corporate tax in the US, in Europe as well, accounts for about 1/3 of all taxes on capital. Taxes on capital, why do taxes on capital matter? If you've read Thomas Piketty's book, you know about R and G. R is bigger than G. The bigger the gap between R and G, the bigger the concentration of wealth in the long run. The R, the rate of return that matters for this computation, for this equation, R bigger than G, is the rate of return on wealth after net of capital taxes. Okay? So if capital taxes, and in particular corporate taxes, fall, R increases, the gap between R and G increases, and everything else equal, you're going to have more concentration of wealth and more concentration of income in the long run. Now, there's no shortage of plans. So what do we do? There's no shortage of plans to fix the corporate tax. So you have some people arguing, well, obviously this is broken, let's abolish it. Repeal of the corporate tax. Now, big problem is that if you do this, this would severely undermine the individual income tax. The key reason why we have a corporate tax is because it's very hard to have a personal income tax and no corporate tax. If you do this, everybody incorporates and retains earnings within companies tax-free, and so the personal tax does not work, the personal income tax. So if you want to tax income, you need to tax income at both the individual level and the corporate level. And more broadly, as I just explained, if you repeal the corporate tax, you reduce capital taxation that can have dramatic effects on inequalities in the long run. So I don't think that's a great idea. Now you have a better approach, which is, yes, we know about these problems with treaties, the double Irish Dutch sandwich, so let's try to do something. So that's the OECD's approach. Maybe some of you have been following this. There's an ambitious plan to curb base erosion and profit shifting, ensure that there are less inconsistencies in bilateral tax treaties. Okay? Is it going to work? Is it going to be effective? I don't know. I'm not very convinced for the very simple reason that the OECD and most OECD countries want to keep this fundamental principle of arm's length pricing. Let's trade, let's do as if the subsidiaries of a given group were completely unrelated and were trading among themselves. I don't think that's the great note that's going to work looking forward. I think there's a simple solution to the artificial shifting of corporate profits to low tax jurisdictions, which is to tax the worldwide consolidated profits of firms. So that's very easy. We know the amount of profits made by Google or Apple or Amazon at the global level. That cannot be manipulated. Okay, that's known. Then you need to figure out how to allocate these global consolidated profits to each country. Now, one simple way to allocate global profits to each country is to do this proportionally to sales. Let's assume that Amazon makes 10% of its sales in the UK. And the UK would say, we are going to assume that 10% of your global profits are in the UK, and we are going to tax you on 10% of your global profits. And that's the end of the game. You can send your profits to Bermuda. You cannot send your customers to Bermuda. Your customers, they are in the UK, in the US, in developing countries, and not in unpopulated tax havens. So in technical terms, that's called formula apportionment based on sales, which simply means take the global profits, allocate them to each country proportionally to where sales are made. And that would remove any tax avoidance opportunity of the form, profit shifting. This graph here, that the share of tax havens in foreign profits will go to zero. There would be no point in having subsidiaries in Bermuda or elsewhere. A slightly more, complicated way is to have a more complicated formula that does not simply use sales but also employment and capital. That's not very important. And I think the simplest way to address the problem of multinational corporate tax dodging is to do exactly what I said: tax global, consolidated worldwide profits, and a portion based on sales. So there's a solution to this big problem that costs a lot of money. And the nice thing is that any country can do this unilaterally. You don't need a lot of international cooperation. So the UK tomorrow could say that's how we're going to tax Amazon or any company. We know their global profits, that's published in their accounts, and we know their sales in the UK, and that's how we tax them. Let me now talk about tax evasion by wealthy individuals, which is also a big problem, especially when you look at the international data that's data on who owns US equities. Who are the foreign countries that own US equities, as recorded by US statisticians? If you look at this data today, the number one foreign investor in US equity markets, it's not the UK, it's not Canada, it's not China, it's not Japan, it's the Cayman Islands. Okay, the Cayman Islands is the number one foreign investor in US equity markets. And more broadly, the share of all US listed equities which are owned by firms or individuals based in tax havens has followed this dramatic trend here. It was very low up to the late 1980s, and since the 1990s it has increased to up to 10%. So today, about 10% of all US equities are owned by tax haven firms. And individuals, so what are these tax haven firms and individuals? What are they doing? Is it legal? Is it illegal? There are many activities that take place in tax havens, in the Cayman Islands in particular, many of which are legal and legitimate, or at least legal, and some of which are completely illegitimate and completely illegal. So the legal and legitimate activities, where you have lots of investment funds, in particular hedge funds, which are incorporated in the Cayman Islands. So the wealth managed by these hedge funds that will show up here. Lots of shadow banking activities like special purpose vehicles, again in the Cayman Islands. Investment funds, think Luxembourg, for instance, a tiny country of 500,000 inhabitants, is the number 2 country in the world for the incorporation of mutual funds, just after the US. And so one other activity in tax havens is wealth management. It's private banks in Switzerland or in Singapore or in Luxembourg again that cater to wealthy individuals to manage their wealth and invest their wealth in global equity markets, bonds, and so on. And now that particular tax haven activity, personal wealth management, can sometimes facilitate tax evasion by wealthy individuals. How does that work? Take the example of a businessman in Texas. He has a carpet making company in Texas, in the US, and he wants to evade taxes. Okay, totally illegally. So we're talking illegal tax evasion. He wants to evade taxes. So first step, he's going to create a shell company. A shell company, for instance, in the Cayman Islands, but it's very easy to create shell companies in many OECD countries as well. Shell company has no identifiable beneficial owner. You create the company, nobody asks you about any document identifying who really owns the company. He creates a shell company, and then he buys from this shell company some fictitious, some non-existent management advice, for instance. So he's going to build a shell company for some services that have never happened, and in payment for these fake services is going to send money to the shell company. The shell company, before that, has opened a bank account in Switzerland. Okay, 60% of all Swiss bank accounts today belong to shell companies. So the shell company opens a bank account in Switzerland, some money flows from Texas to Switzerland as payment for these fake services. Everything at first glance seems legitimate. You have billions of transactions across countries, including to low tax countries every year. But once the money has arrived in Switzerland, actually this Texan carpet maker can make investment from his Swiss account, buy UK equities or German bonds and so on, earn income on these investments, capital gains, interest, dividends, and he will not pay any tax unless he chooses to report this income to the IRS, the US tax authority, or unless the Swiss bank reports this income to the IRS. But if none of this happens, then this guy can totally evade taxes. And in the books of the Swiss bank, there's going to be a lot of wealth that on paper belongs to a shell company, and really the shell company is anonymous. Think of this as numbered accounts. 1970s, up to 1970, numbered accounts were widely used. On the document, what was appearing was not the name and address of the account owner, it was just numbers, figures. Now, today, numbered accounts are prohibited by anti-money laundering regulations, and they've been replaced by accounts that belong to shell companies. So it's not a series of numbers, it's just a series of letters that appear on the bank documents. Okay? The bank accounts belong to shell company ABCD. What do we know about the magnitude of offshore tax evasion of this kind? Now, the great thing is that the Swiss National Bank actually publishes monthly data on the wealth that's managed by Swiss banks that belongs to foreign residents, non-Swiss residents. Latest data point is for October 2014 and says, well, there's $2.5 trillion of foreign wealth in Switzerland. So we know this as a fact. We know that the majority of this belongs to residents of rich countries, actually, residents of Europe, a little bit to Americans, but a growing fraction belongs to residents of developing countries, Russia, Africa, Asia, and so on. What else do we know? So there are also similar statistics in Luxembourg. This is fine. And then you have these inconsistency anomalies in the global data, which are, when you take all the financial assets of all countries as recorded in the national accounts, and you take all the liabilities of countries, so you look at the world's balance sheet. In principle, financial assets should balance liabilities. That should be exactly the same thing. There's a large gap. Financial assets, identifiable, recorded financial assets are substantially lower than recorded liabilities. And this has many sources, but one key source is all the wealth that's held through Swiss accounts or through bank accounts in Luxembourg and so on, actually is well recorded on the liability side of the world's balance sheet, but not on the asset side. Take a simple example. I'm now a UK resident. Let's imagine I have a Swiss account, and through my Swiss account, I invest in Microsoft equities. So I have US equities on my Swiss account. From the viewpoint of the US, that's a liability for the US. Okay, and US statisticians, they see, oh, there's, foreigners who own US equities. That's a liability for the US. UK statisticians, they would like to record an asset, but they can't, because they don't know that I have this Swiss account. In Switzerland, people, statisticians observe that, there's this foreign person or this shell company that owns US equities. That's none of Switzerland's business. That's neither an asset nor a liability for Switzerland, so nothing is recorded in Switzerland. So you see that more liabilities than assets are going to be recorded in the world's balance sheet. So using these anomalies, I have computed that about 8% of the world's financial wealth is held offshore today. And if anything, that's a lower bound. Why? Because this only captures financial wealth. Equities, bonds, mutual fund shares, some derivatives, and bank deposits. But this disregards real estate, works of art, and real assets in general in tax havens. That I can't capture with this method. What's the fraction of all this wealth that evades taxes? Or to put it differently, what's the fraction that people with Swiss accounts and so on choose to voluntarily self-declare to their home country tax authority? There's some uncertainty on this. There's again some pretty good data from Switzerland suggesting that at least in Switzerland today, still 80% of the 2.5 trillion of offshore wealth in Switzerland evades taxes. So 8% of the world's financial wealth, that's the number here, that's a global average for all countries. At the global level, 8% of the world's financial wealth is held offshore, but there's a lot of heterogeneity across countries. So for the US, that's going to be about 4% of the financial wealth of the US that's owned by US residents through offshore financial institutions. For Europe, it's going to be 10. For developing countries, this is going to be very big. More than 20% for Latin America, 30% for Africa, maybe 50% for Russia, and more for Gulf countries. So that's very quantitatively important for not only the rich world, but developing countries as well. And the tax revenue loss for governments, I say more than 200 billion, because this 190 billion figures here, again, only captures tax evasion on financial wealth, but disregards real assets. The good news is that in recent months, really, a lot of progress has been made in in attempting to curb that particular form of tax evasion, unreported wealth and income on offshore accounts. How is that possible? Well, by having offshore banks automatically sending information to foreign tax authorities. So now, almost all of the world's tax havens have agreed to send to the US tax authority, the IRS, the information that they have about the income and wealth of their clients who are US citizens. That's the Foreign Account Tax Compliance Act. Most of tax havens have, committed to do the same by 2017, 2018 for other OECD countries. So maybe by the end of this decade, there will be an automatic exchange of bank information at the global level. Now, that's great, and that's great, and that's a huge step forward, but still there are three obstacles here. One obstacle is that you cannot simply politely ask offshore bankers, many of them are very honest people and will abide by the law, but some of them have become very rich by facilitating tax evasion. So you cannot ask the very same people who've been facilitating tax evasion all of a sudden to do the opposite and to play the taxman's job. You know, that the incentives here, there's an incentive problem. You need to put incentives for, you know, having actually offshore bankers sending the right information. Otherwise, what's the information that they're going to send? They're going to say, well, we don't have UK customers, you know, we don't have US customers. No, really, we don't have any customers. So we are not sending any information. The best way to deal with this issue is to have well-defined sanctions for non-compliance. Okay, if there's no specific penalty attached to either not participating to this system of automatic exchange of tax information or to failing to provide the right information, if there's no sanction, you know, the incentive for offshore tax havens to continue engaging in illicit tax evasion will remain strong and tax evasion will continue. But the good news is that, yes, if you have clearly defined sanctions, then, you know, it will become unprofitable for tax havens to actually encourage tax evasion. And yes, tax evasion, at least this type of tax evasion, could disappear, or could diminish a lot. And yes, that would make it possible to actually have a global wealth tax. That's the type of things, you know, if you can't really hide your wealth anywhere, if there's an automatic exchange of tax information at the global level, yes, you start thinking in practical terms about global wealth taxation. Now, as I was saying, and I will conclude with this, there's, in the next slide, there's one obstacle which is, okay, securing the compliance from offshore bankers. Two other obstacles is what I'm calling the opacity of international financial record keeping, which is in the books of these, you know, banks, there's 60% or more of the wealth that belongs to shell companies with no clearly identifiable owners. So how do you deal with this issue that there's a lot of wealth that really belongs to nobody, and with this other issue that, you know, offshore bankers may not really send the right information? In top of the automatic exchange of tax information, I think what we need today is a world financial registry. A world financial registry would make it possible to really curb tax evasion and to make big progress in the measurement of financial wealth. What is it and why do we need it? And that's the conclusion. What is it? We have land registries, real estate registries in all countries, and sometimes for a very, very long time. For centuries in the UK, there's been a land registry that records who owns the real wealth, the land, the real estate in the country. That's the same in the US. You can, you know, connect on, you know, the website of the US municipality and type in any address in New York, and you can know who actually owns this building. Or you can type in any name, and you can know if any particular person owns anything anywhere in New York. You know, that's public information, and that's been there for a very long time. But when these real registries were created, for instance, in 1791 in France, centuries ago, financial wealth was very small. Land, real estate accounted for the bulk of wealth. So these registries, they did capture almost all of people's wealth. Today, they only capture, you know, 40, 50, depending on the country, 50% of people's wealth. The rest is financial wealth. So we need to do the same thing as we do for real assets, but now for equities, bonds, mutual fund shares, derivatives. What's the goal? The goal is, first of all, just to be able to better measure wealth. No, it's fine to have reports by private banks, by non-profit organizations, you know, by researchers on what we think are the trends in the distribution of wealth. It would be much better if actually this kind of information was directly provided by government statistical agencies. Okay, if you know, the UK, the Office for National Statistics could say the top 0.1% wealth share in the UK, that's X. That's exactly the type of tool that you need to obtain this information. And the states go way beyond tax evasion, so this would help a lot curb tax evasion, but this would help a lot better monitor financial stability. For instance, when you have a huge gap between assets and liabilities, it's just very hard to know who owns what and to monitor financial stability. And that's the conclusion. Is it possible? Yes, because financial registries already exist today, but they are partial, fragmentary, and they are managed by private financial institutions like Euroclear in Europe or Clearstream in Luxembourg or the Depository Trust Corporation in the US. So what we simply need is to merge these registries to create a public financial registry, and ideally at the world level. Thank you very much.
So now there's time for some Q&A. So please wait till one of the stewards hands you the microphone, so everybody can listen to your question. I think there's a question over there.
I would like to make you a question. I'm Italian, so the problem of tax avoidance is quite huge in Italy. But recently, in the last 3-4 years, happened that many Italian individuals that they do business, they move their business in England, even if 80% of the business is done outside UK. So that's basically the point that you touch when you talk about shifting profit. And so basically, even if they produce business in Italy or in Spain, other country, at the end of the day, they decide to move to UK because the taxation is lower. So my point is that why no one understands this kind of move? And that at the end of the day, these people, they don't stay in UK, they only open a company here, but they stay in Greece, Italy, or Spain.
You want to answer now, or you want to collect a couple? So maybe we collect like a couple questions, and then one there, and one.
Right, I have a question regarding your proposal to split up profits according to sales in different countries. So, the first point is, I don't think taxes are just for redistributory purposes, but also partly at least to pay for government services, roads, things like that, infrastructure. Now, what if a company exports all of its products to a different country, which is often the case in this integrated industries we see today? Now, if you then split up profits according to sales, the country where the exporter produces and uses infrastructure and government services does not actually get any taxes. Now, I don't think this is particularly fair. And the second point, or the second question, regards the incentives that countries face. So even if we, for personal income taxation, institute this system where we have this financial registry, it is still the case that the largest wealth holders are also physically most mobile. And it's probably also the case that countries still face an incentive to lower tax rates and to get this tax base into their countries. So even if we register those, what we might see is a reduction in illicit tax evasion, but there might probably be an increase, or potentially be an increase, in sort of legal tax evasion, in the sense that countries will adapt their legal systems.
Thank you. I also have two questions. The first question is also regarding the split up of profits or taxes. So the European Union tried to implement a system like that, I think, some years ago, and it failed, also due to a reason which a colleague already mentioned. And you said, you gave an example, for example, you said, okay, in the UK we know the worldwide profit, so we could say sales are X and like the term tax. But is the problem in the first place not that at the moment we don't know what is, for example, Amazon, we don't know like how many sales they, for example, have in Germany. They kind of didn't reveal it for a long time. So a lot of people say in the first place we should kind of implement real segmented reporting. And my second question is concerning the graph you showed, I think was the second or third slide, where you could see that in the 70s there was like a huge increase in the wealth, the 0.1% in US held. And my question is, this huge increase in the 70s, might it be to the end of the Bretton Woods system? Do you have like any reasoning why there's like this sharp increase? Because, for example, some researchers like James Tobin, I think he kind of proposed in that direction and said that due to like the globalized exchange rate markets, this spread happened. Thank you.
Okay, so let me try to answer the starting with the last question. So in 1970s, what happens to the distribution of wealth in the US is that the top 0.1% wealth share falls, in the 1970s. That's the historical minimum is actually in the late 1970s. And I think you're right that this is totally linked to turmoil on, global markets, equity, bond, currency markets, which in turn, have probably something to do with, the move from fixed exchange rate to floating exchange rate. So at least that's one possibility. Well, there are many other things that happen, oil shocks and many other things. But it's clear that in any case, 1970s, it's a very bad decade for people with a lot of financial wealth. Just the price of financial assets falls a lot for a variety of reasons. Questions about, okay, is it really such a great idea to allocate global profits based on sales? I really think it is a good idea. Why? It's true that, sales are not really correlated to the location of profits. So you can have a firm, okay, it employs many people in the UK, has its factories in the UK, it's only selling to China. So with my system, the taxing rights in some sense would be allocated to China and not to the UK. And you may say, well, that's crazy and that's really a bad idea. I don't think so for the following reason. You should think of the corporate tax as essentially it's a prepayment for the personal income tax. It is eventually, corporations, they don't pay taxes. Real people pay taxes. For a very long time, the way that the corporate tax worked, including in the UK, is that it was integrated with the personal income tax, which is that some taxes are withheld at the corporate level, and then when corporations distribute dividends to shareholders receive a credit for all the taxes that have previously been withheld at the corporate level. And conceptually, that's the right way to think about corporate taxation, which is we want to tax shareholders immediately, whether they receive dividends or not. We want to tax them immediately at the corporate level, and then when they receive dividends, well, we are not going to tax them twice, we are going to give them a credit. And so we don't care exactly which country levies the corporate tax. Now, what matters is that all corporations pay taxes, whether they're big or small, whether they're in the manufacturing sector or in the IT sector, at pretty high rates. And then, that's how we tax shareholders immediately when economic profits accrue to shareholders. So and the system I'm describing is doing this very well. It ensures that all corporations, big or small, IT or manufacturing, are going to pay a lot of taxes. That's what matters. The mobility of high-income individuals, that's a potential. Yes, the potential threat to the World Financial Registry, it's not a threat, but the potential response is, yes, okay, if people cannot evade taxes anymore illegally, then they're going just to move their residence to the Bahamas or, Cayman Islands or to countries with zero personal income tax rates. Is that a big threat? I don't think so. What's the evidence on the mobility of very high income individuals? It's not huge, and people are not really willing to to move to Bermuda to not pay taxes. You know, there are data in the US, quarterly data, on the number of people renouncing US citizenship, and it's very small. And it's maybe 2,000 or 3,000 Americans every year renounce US citizenship, but 400,000, 500,000 actually acquire US citizenship. So it's not, you know, these are very small flows. So I don't think that's a big problem right now, and I don't see this as becoming a very big problem in the near future. And so for the question on what happens in Italy, yes, you know, people move their businesses all across England, and you know, I think again the nice a nice feature of the plan I was describing is that removes any incentive for actually moving your headquarters or your workforce or your factories all over the world. Wherever your factories, etc., are located, you're actually going to pay the same profit, the same taxes, right? Because all countries are going to start from your global consolidated profit that do not depend where your headquarters is, and you know, apportion this based on sales. So that's another nice feature of this plan. It removes any incentive for artificial profit shifting, and also any incentive for tax competition for real factors of production.
Another round. Is that a microphone? Oh, yeah. You want?
When you refer to higher progressive income tax rates, what would you say the highest possible rates should be for income tax?
I think there was another question.
My question is, how would you implement your plan with industries that don't necessarily sell a physical product, like, for example, Google?
My question is about the consolidated corporation tax base. I think, European Union been trying to do that for more than a decade, but they not succeed yet. How could you persuade the country to do that? Because basically every nation, every tax authority will calculate will the country gain or loss from that tax base. Then they will decide whether they will join to the tax base or not. And obviously, some country will gain from that policy, some will lose. So how can you implicate that policy? Thank you.
Yes, that's a very good and very important question, and I think the short answer is by using threats and clearly defined penalties for countries that do not want to cooperate and that continue to want to still be able to facilitate widespread tax avoidance. So in particular, I think if we had a serious European Commission president, that's what he would have done in the aftermath of the LuxLeaks scandal, that indeed there is this long-standing European plan for doing what I was describing, taxing consolidated profits, which is known as the CCCTB, the Common Consolidated Corporate Tax Base. European countries have been discussing this for decades. Nothing happens. Oh, by the way, this already exists in the US. This is how the US taxes companies for the state corporate tax. You think of a US company that has activities in New Jersey, in California, in Texas. All these states, maybe not taxes, but they have a corporate income tax. The way that the profits of this US firm are allocated to New Jersey or California, it's exactly the system that I'm describing. It's starting from the consolidated US profits of the firm and looking at the fraction of sales made in California, the fraction of sales made in New Jersey. So that has been in place. That works very well in the US. That's been there for decades. The European Commission and European countries have been discussing this for a very long time. The simplest way to move forward is to say, well, who are the countries who refuse to move forward? Why do they refuse? There's just no good reason. They're just stealing basically the tax revenue of, their neighboring European countries. This works in the US. If you don't want to do this, countries that feel their tax revenue are being stolen will, impose well-defined economic sanctions. That's the best way, I think, to make progress. That's how the US, for instance, has been able to secure the cooperation of most tax havens for the Foreign Account Tax Compliance Act, which is there's a 30% tax withheld by the US on any payments made to a foreign bank that refuses to send information to the IRS. Okay, and that has been extremely powerful in securing cooperation. What problem is, do we really know where the sales are made? How do we know who Google makes its where Google makes its sales? I think we do actually know this pretty well, in particular in Europe, because this is well measured for the VAT. So we have good systems to record the location of final sales. Who are the people who consume, who purchase Google ads, for instance, who buy books on Amazon? This is not, totally perfect, but actually there is already an infrastructure for the VAT to determine this pretty precisely. And let me, try to answer this question of what's the highest possible income tax rate. The highest possible income, possible it's 100%, but the highest, what the optimal income tax rate. There's a vast economic literature on optimal taxation that tries to address this question. And that says, well, it's going to depend basically on two things. This is going to depend on inequality. So everything else equal, more inequality means the higher the optimal income tax rate, the top marginal income tax rate. And this is going to depend on the elasticity of taxable income with respect to the net of to the tax rate, let's say. So this is going to depend on the extent to which people work less or put less effort in their work or even leave the labor force in response to an increase in the tax rate. Now, there have been tons of studies trying to estimate this elasticity. When you take the best estimates, you find that, in the long run, the elasticity of labor supply, what I just described, is not extremely high. When you combine this with what we know about distribution of income inequality in the UK and the US, you get optimal income tax rates, which are typically in the 70–80% range. Okay? That's the tax rate that's going to maximize tax revenue. That is, any tax rate above 80% would be self-defeating for the government. The government would lose revenue, but 80%, that's the top of the Laffer curve. You maximize tax revenue. 80% that includes all taxes on income. So that's not only if you want to make this concrete, it's not only the personal income tax rate in the UK. You need to add social security taxes or national insurance contributions in the UK. You combine all of this, and the optimal tax rate is probably around 80% in the UK today.
Next round.
My question is that even if you manage to collect the correct amount of taxes from corporations and companies, how do you know that national governments will actually use the revenue generated from these taxes to address inequality, not just spending on general government things?
I think there was another question on the balcony too.
You rejected as a response to corporate profit shifting a potential alternative solution, which would be to abolish corporation tax altogether and presumably to levy other taxes in its place. And the reason you gave for rejecting that approach was because you need some at least approximate equivalents of income tax and corporation tax, or some tax on corporations, because otherwise individuals will incorporate in order to avoid income tax. And of course, one way you might alleviate that problem would be then just to tax the individual when they withdraw money from the company, so when they take dividends. And later on in your answer to an earlier question, you said that the problem with that was something along the lines of it would be better to tax the corporate profit when it arises rather than to wait for people for individuals to take dividends from the company. And I just wondered why you thought it was preferable to tax immediately rather than to wait.
Yeah, great. Thank you very much for a very insightful lecture. My name is Toshi from Westminster University. I'm a student there. And my question is about the sanction for the country or the financial institution not complying with such bilateral or multilateral agreement. I was wondering if there's an effective sanction at the moment, or is any initiative to have a universal sanction for such activities. Thank you very much.
Yeah, I think the main example is the one I mentioned on the Foreign Account Tax Compliance Act in the US, which is really the US saying any bank abroad, any financial institution that refuses to automatically send us information, everything they know about the income and the wealth of their US citizens, customers, any such institution will be subject to a 30% tax withheld at source by US financial institutions. So that's, and given the huge size of the US in world financial markets and so on, that's, you know, a major threat. And you know, you look at what happened, this has worked very well. So in the sense that this does not have to be even applied, you know, it's just a threat that's enough to make progress. You know, for a very long time you had zero exchange of bank information between tax havens and foreign countries. Nothing whatsoever. And now, you know, starting right now, there is a lot of information all of a sudden that's being sent to the US tax authority, and maybe by the end of this decade to HMRC, or, you know, tax authorities in Europe and hopefully in developing countries. So I think this is a pretty striking example. Why is it preferable to tax income when it is realized rather than waiting that for shareholders to withdraw income from their company? It's very simple, you know. Imagine you're a billionaire. You have 10 billion pounds of wealth. That wealth generates dividends, okay? And the dividends are going to be paid not directly to you, they're going to be paid to an intermediate holding company, okay? So the intermediate holding company is going to receive, you know, let's say 500 million pounds every year in income. You don't need 500 million pounds to enjoy a good life, you know, you only need maybe a few million pounds. So you're going to only withdraw 1 or 2 million pounds from this intermediate wealth holding company. The bottom line is that you're going to pay taxes on only this 1 or 2 million, despite the fact that your true economic income is 500 million pounds. Okay, and this can go on forever. Okay, so that's the key reason why you want to tax the 500 million pounds at the corporate level. And then what will governments do with all the money that they're going to raise with extra taxes on the rich? Well, I think the best thing to do would be to actually cut taxes for
the rest of the population, the middle class or low-income families. The goal is not to increase tax revenue, at least not in Europe, where they are pretty high. Maybe in the US, yes, maybe, but in most European countries, or like France, where I come from, that's certainly not the goal. It's just you raise more taxes at the top end of the distribution, you can cut taxes for the middle class, which then makes it easier for the middle class to, enjoy a higher standard of living, save, build wealth, and so on.
Any final question left? There's one over there, in the middle, and one in the back, and then... Oh, just go ahead.
Hello? Sorry. So tonight you've talked about some of the potential technical solutions to a lot of these problems. I wanted to ask you more about the process that's needed to bring about change. So, for example, I'm Scandinavian, so I'm brought up with a certain cultural perspective on taxation, which might be very different to some of the American outrageous sort of reactions to President Obama's proposal of increasing tax rates on the wealthiest. So with this sort of divergence, what can you say about the, rather than specifically economic, but more cultural and almost psychological attitudes that constrain any progress within this area of taxation?
Hi there. Obviously, you've got the 2015 election coming up. But I'd like to say that obviously, that Labour, they're proposing a mansion tax on properties more than 2 million. And that's obviously going to affect the economy a lot because that's applying to 0.5% of homes in the UK. And obviously what they're trying to do is they're trying to contribute to the UK. They're trying to, spread that, wealth towards the low-income people. And obviously that could fund for, the NHS, other sectors of the economy. It could fund for, the army. But what I'd like to say is, do you think that the mansion tax is the correct policy for long-term inequality changes instead of just short-term?
And the last question I think was, right there.
So you talked mostly about leakage of tax revenue from high tax countries to these tax havens and special structures. But what about the incentives that creates for higher investment in both the tax havens and also the neighboring high tax countries? Does it not increase the amount of financial competition, increase the amount of debt financing that multinationals use in both high tax and lower tax places?
Let me say that, generally speaking, taxes affect, of course, the behavior of people and firms, and we know a little bit about this. We don't know as much as we would like to know. Do they affect, long-run investment decisions a lot? In a very broad sense, not really. If you take, for instance, if you think about the UK or France over centuries. You start, in the early 19th century, and you look, in the 19th century there was no tax, basically. At least no tax on corporation, no tax on capital, very little, very, very little taxation of capital. And the saving rate or the investment rate was about 10% of national income. Okay, and today, we have all forms of taxes on corporations at the personal level, on capital gains, on estates, and the private saving and investment rate is still about 10%, and it's very stable in the long run. So this is in broad sense to say that, you know, it does not seem like taxes in the long run have a huge effect on at least aggregate investment or aggregate saving. You know, people save for tons of reasons that vary across countries and over time, but it seems that it's pretty, in the end, the flow of savings seems pretty stable compared to GDP. Now, of course, it does not mean that it's not going to affect the way that people save or, you know, the use of debt versus equity. That's totally true. But in some sense, what we care about is really the total flow of investment. You know, we want our economies to invest a little bit. That's good. You know, and it seems that here taxes do not play such a big role. Now, about the mentioned tax, well, in the long run, I don't think that it's, you know, I don't think that's the best way to actually address rising inequality in the UK. You know, I think people overemphasize property, the usefulness of property taxes. Property taxes are very old taxes, have been existing for centuries, and the fact is that the higher up you move in the wealth distribution, the higher the share of financial assets, and the lower the fraction of your wealth that actually takes the form of housing or real assets. So you must think of property taxes or real estate taxes as not, you know, taxes on the very wealthy. These are taxes, you know, on the wealthy middle class, or sometimes on, you know, pretty wealthy people, but certainly not on the wealthiest people. Wealthiest people, 90% or more of their wealth is financial wealth, and in particular equity wealth. So if you are really concerned about using taxes on wealth, like property taxes, to deal with inequality, rising inequality, what's much better than a mention tax or any change to the property tax is a tax on total net wealth. Total wealth, not only housing, but housing plus financial assets, net of debt. That's a much more powerful way to actually address rising inequality in the long run. And so what about the cultural attitudes that prevent changes? I'm not so convinced that this is a major obstacle, at least in the very long run, in the sense that cultural attitudes toward taxes, they do change a lot. The US today, you may think, okay, that's the country, okay, they don't want to raise taxes, there is all this opposition, you know, to even tiny increases in taxes to fund the Affordable Care Act, and so, but actually the US, you know, go back to 1940s, 50s, 60s, 70s, the US invented the Roosevelt-like top tax rates, tax rates of 90% or more on incomes above the equivalent of $1 million today. That was in place in the US for half of the 20th century, and very, very high tax rates on estates, on top estates as well. So these things, I think, they change. They change depending to a large extent to a large extent on how the distribution of income and wealth changes. So it's very much as a response to rising inequality that the US introduced these very high tax rates. And so it's likely, or at least not impossible, that the same will happen at some point in the 21st century when you have extreme levels of wealth concentration. You know, cultural attitudes change and respond to this, and so I'm pretty, you know, optimistic in that regard.
All right. So to conclude, I'd like to thank you all for coming and ask you to join me in thanking our speaker, Gabriel Zucman, one more time.